Since the reports of the conflict between the US and Iran hit the wire, the general reaction has been defined by fear. But in the global markets, fear is a catalyst for calculation. Money doesn't simply disappear during a war, it reallocates. It moves from promises, speculative growth and future tech, to provisions, the raw materials and energy required to sustain a nation in crisis. This is a massive migration of capital from the intangible to the tangible. Today, we're looking at the strategic investment layers of this conflict. We're going to map out who actually strengthens when the system is under this much stress, and why certain old world assets suddenly become the only thing that matters. We aren't just looking at a market cycle, we are looking at a fundamental shift in the global hierarchy. Understanding this map is the difference between being a victim of the volatility and being a strategic observer of the new baseline. The most obvious domino in this chain is the energy shock. If the Strait of Hormuz is contested, we aren't just looking at a temporary price spike at the pump, we are looking at a structural redistribution of global wealth. As supply lines tighten, the value of every existing barrel of oil doubles or triples. This creates an immediate windfall for those who can still move product. The primary winners here are the producers positioned outside the immediate line of fire. US shale, Middle East exporters with bypass pipelines, and LNG infrastructure firms see an explosion in cash flow that can reshape their balance sheets for a decade, but it goes deeper than the oil companies themselves. The infrastructure, the pipelines, the storage hubs, and the LNG terminals becomes the most valuable real estate on Earth. In this layer, energy independence isn't just a political talking point or a campaign slogan. It is the ultimate economic advantage. When the global heart stops beating, those who own the backup generators become the new masters of the market. You might think a war for oil would kill the green transition, but the data suggests the opposite. As fossil fuels become volatile, expensive, and politically compromised, the narrative for energy independence through electrification strengthens. This isn't necessarily driven by environmentalism anymore. It's driven by national security. Governments realize that relying on a single, vulnerable choke point for their entire transport sector is a strategic failure. When gasoline hits record highs, the operating cost of an EV becomes significantly cheaper by comparison, accelerating consumer adoption even in a downturn. This creates a massive strategic advantage for the battery supply chain and grid infrastructure. However, there's a critical catch. Producing these vehicles is energy and metal intensive. This transition becomes a high stakes race against rising production costs. The real winners here aren't just the companies selling the cars, but those who own the vertical supply chain, the ones who control the lithium, the nickel, and the processing plants. It's a shift from fuel security to material security. This brings us to the backbone of the war economy, industrial metals. Between a surge in defense spending, the reshoring of supply chains to friendly nations, and the massive push for electrification, the demand for raw materials goes into overdrive. We are entering a period where the physical world is reasserting its dominance over the digital world. Copper, nickel, and lithium are no longer just commodities. They are strategic assets. Copper is the lifeblood of the modern grid, but silver is the standout in this environment. Silver is what we call a hybrid asset. On one hand, it's an industrial necessity, vital for everything from solar panels to military-grade electronics and missile guidance systems. On the other hand, it's a monetary hedge, much like gold, but with significantly higher volatility and upside potential during a crisis. In a high-stress scenario, silver benefits from both the frantic industrial demand of a war footing and the desperate flight to safety by investors. It is the dual threat asset of the fortress era, and its scarcity becomes a defining factor in global production. As inflation spikes and currency risk grows, we see a massive rotation in global capital. Investors stop betting on growth at all costs and start hiding in real assets. The era of cheap money and endless digital expansion is replaced by the defensive crouch. This is a period of capital preservation, where the goal isn't to get rich, but to avoid being liquidated by the debasement of the currency. Gold remains the primary hedge, the ultimate sovereign shield against systemic collapse. But the broader strategy here is defensive. In a stagflationary environment where growth is low but prices remain stubbornly high, cash and short duration bonds become surprisingly valuable for their optionality. They provide the dry powder needed to buy when the dust finally settles. Meanwhile, the high growth tech stocks that dominated the last decade, those sensitive to both rising interest rates and skyrocketing energy costs, become the primary losers of this rotation. Investors are no longer looking for the next unicorn. They are looking for a vault. Finally, we see a total reallocation of capital. For the last decade, big tech and Silicon Valley were the only games in town. But an Iran US conflict flips the script entirely. AI and massive data centers become incredibly expensive to run as energy costs soar, and the capital that once fueled them begins to flow back into the old economy. We are seeing the revenge of the real world. We are talking about energy, materials, and heavy industrial production. The strategic map of a war economy favors countries and companies that actually own things, the resources, the mines, and the factories. The winners are those with resource ownership and stable, self contained internal systems. The losers in this new reality, import dependent economies and consumer sectors that rely on cheap energy and a happy, high spending middle class. The old economy is no longer a relic of the past. It is the fortress that protects a nation's future. War is the ultimate stress test for an economy. It reveals with brutal clarity what is essential and what is a luxury. The strategic implications of a US Iran conflict suggest a world moving toward fortress economies, a world where energy, strategic metals, and hard assets aren't just investments. They are the fundamental requirements for survival. We are moving away from the just in time efficiency of the last 40 years and into an era of just in case resilience. As the system moves toward this new baseline, the real question for any observer isn't when will it end, but how is the world being permanently reshaped while it's happening? The maps are being redrawn and the rules of wealth are being rewritten. Understanding these layers is the only way to navigate the shift. Keep your needle pointed here. I'm Compass. Thanks for navigating with me.